All right. We are live right now. We're going to go ahead and check our audio. So if you can hear us, let us know. But last week, our entire live event went without audio. So we've got our green lights here. We've got our mics ready to go. Matt's going to jump on real quick and just make sure before we get started. If you are in the call, just go ahead and leave a comment. Let us know if you can hear us, if that's clear. So you want to check through LinkedIn? Oh, are you connected there? That's good.
We're live.
Okay, awesome. Cool. All right. Well, we're excited to get into kind of our second session around becoming bulletproof and what we believe to be a solid game plan and strategy, and kind of a handful of strategies that help business owners become bulletproof and bulletproof themselves by building personal portfolios of real estate. And so today we're going to be talking on real estate professional status, why that can be so powerful for you. Last week, we were really trying to narrow in on talking with real estate agents. We are real estate agents, and we want to spread the word on the fact that they qualify as real estate professionals, because there's a lot of agents, there's a lot of weird information out there floating around on how you qualify, how it's impossible to qualify. And agents literally have no idea. I mean, I know agents who've been in the industry for 15, 20 years, and they know that they're a real estate professional, but what does that mean? What does that get you? Most people don't know the benefits of how to actually use that as a strategy, how the amazing tax benefits that come with it. So we want to touch on the importance of utilizing this strategy, just like a no-brainer concept of when somebody has a job and they have like a 401k employer match, right?
Your employer gives you a match on how much you put in. Let's say you put in 5% of your income and they match up to 5%. If you put in $10,000 for the year, they will give you $10,000 into the same account. That concept, the free money, this is available to you as a perk here. You have to be taking advantage of that. In the same way, this real estate professional status and the benefits that it gives you on the tax side is something that we have to take advantage of. It's a no-brainer not to, or it's a no-brainer to make sure that we're taking advantage of what's available to us.
And even like bigger scale, bigger picture than just taking advantage of like your real estate professional status for the tax side of things. Taking advantage of investing in real estate as a real estate agent as a whole. This, if you are a full-time real estate agent and this is your career, like this is your career path, you are in real estate full-time. You are in front of deals all the time. If you don't own and aren't planning to own real estate as like a part of your retirement plan, right? That seems really weird, right? You understand, you know what it is you're investing in. You're around it all the time. You're in it every day. You're helping advise clients. You have deals floating across your desk all the time, right?
In your pocket, exactly. Real pocket listings.
Yes, yeah. So if you're not like spending time looking at the opportunities in front of you to invest in real estate as a real estate agent, you're missing like the most powerful, in my opinion, you're missing the most powerful piece of real estate.
And we're going to break down a deal later that shows the numbers of it, specifically in the context of real estate professional status. But if it's a new concept, if you're like, oh wait, it is a powerful investment tool, not just a real estate professional status, but also the breakdown of what's available when you get into a deal, your cash-on-cash return, term that gets thrown around, your cash-on-cash return for that deal is huge.
Yes.
Capabilities are big within real estate, much bigger than just like small, easy, safer returns. There's safer returns in diversified large index funds, but there's a benefit to investing in what you know. And we know real estate as real estate professionals, as real estate agents.
Yep. And in that deal breakdown that we're going to go over kind of towards the end of this live session, we're not using like vague numbers. Like this is a pocket deal that we have coming on the market. We're going to use the numbers that it has right now. Like it is a current rental. We're going to use what it's going to be priced at. We're going to use the rent that it brings in. We're going to use all real numbers so that you can like be like, oh, how does this actually work? Because a lot of people like to sit up here, they do a video like this and they'll use like big broad numbers. And it's like, if you buy a house for $200K and then you're like, where are you finding a house for $200K that rents
Not
for
in Phoenix.
$3,000? Like, what the heck are you even talking about? So we're going to like actually break down real numbers and show you exactly what it is. And probably is going to blow your mind because it blows ours every time you sit down to like run the numbers and you're like, holy cow, I have a massive advantage as a real estate agent here looking at deals. So we're really excited for that. So let's dive in. Let's start by overview of like what is real estate, what is a real estate professional, and what is that status under the IRS, and like what does it give you, right? So if you qualify as a real estate professional, we'll get into how you qualify or what qualifies you. The benefit that you get is you get this opportunity to participate in your rental properties. And when you participate in your rental properties, those rental properties become an active source of income rather than just a passive source of income, right? So let's talk real quick about, I'm going to pull up this screen here. There we go. Okay, so this is going to give you a pretty good outline of what this looks, right? So you have the IRS, and they say, hey, we're going to split all of your income and losses, like your income and losses, into two separate sides, right? This is where we start when we advise clients and we're talking through tax strategy with around some of their real estate portfolio. This is where we start with everybody, because understanding this rule here that you see on the screen, it seems so simple, but the more you like look at it, the more you're like, oh wait, this applies. Oh yeah, this applies. And so understanding this principle, this is really important for us to start. So the IRS divides your income and losses into two separate things, right? Active and passive side. So on the active side, you're going to have things like W-2, you or your spouse. Maybe your spouse is a W-2 worker, and maybe you're the 1099, right? Like us as independent contractors, real estate agents, we're getting a 1099 in most cases, probably 95% of cases. Now, maybe your spouse is a W-2 from a job they're bringing in, okay? All of that you get by the sweat of your brow, right? You're working every day. That's active income.
What's an active loss?
You get to, so if you're a business owner, right, anything that I'm taking, so as a real estate agent, I have all sorts of things that I can deduct against my income. I can take active losses and deduct those against. So if I'm writing off a piece of equipment, I'm writing off a car, I'm writing off my computer for work, I'm writing off, that is an active loss, okay? So with active income, active loss, those sit on that side, right? On the passive side, you've got different retirement accounts, investment accounts, and the big one that we're going to be talking about, rental real estate. Okay, so sometimes there's some cases, now you're going to hear this when you start digging into this a little bit more, something called about a short-term rental loophole, right? That's basically just a way of turning your house, your rental property, into a full-time business that's active, right? So your average guest is staying there less than 7 days. You're materially participating there, right? It's more of like think of like a hotel, like maybe not quite that. That might not be the most. CPAs are going to get on my butt about that.
You don't want to use that word with loans.
Right. But it's an active business, right? It's not just like me setting a renter in there for a year, checking in on them 3 times, right? It's me going to the property, right? I'm cleaning it. I'm doing everything. It's a business. It's an active business. So that's what, the short-term rental loophole, when you see that, that's just a way to make the property active. Yeah. All other rental properties, if you have a long-term tenant in there, it's going to be passive. And it doesn't matter if you spent 1 billion hours in there, right? All your hours out of the year, which would be far less than 1 billion, but let's just say 1 billion. You still can't make that active. Regular people can't make that active, right? They might not qualify as a real estate professional. But you, as a real estate professional, can turn that rental real estate active. And so what that means is, hey, we've got passive income and passive losses. The IRS wants you to stay on either side of this, right? So I've got active income. I can only deduct active losses against that. Passive income, I can only deduct passive losses against that. Well, it's really easy to show paper losses with real estate, right? Because the big D word, depreciation, right? So on your Schedule E, when you get to show a bunch of income and then a bunch of deductions, line, I forget what it is, line 16 or 17 or 18, somewhere around there. It's depreciation, right? That's a big amount normally that you can put there. So when you create an excess loss with depreciation, normal people have to keep that. We'll go back to that slide. Normal people have to keep that on the passive side right here. They have to just, okay, I can only use that depreciation. I can only use those losses against passive income.
It's not a use it or lose it. It's if you don't use it now, you put it in a bucket, you save it for later.
Right. Yep. But now we're talking about real estate professional status today. We're talking specifically about the benefits of what this looks like. You as a real estate professional, and if you qualify you and your spouse, Okay, so it's if you're filing jointly, it's for both of you. Now, if you materially participate in your rental properties, you can take the losses that you incur from your rental properties and actually deduct that against your active income. So against your active income, like commissions, right? Maybe you had a great year, boom, you filled up this big bucket of income of commissions coming in this year. Well, guess what? You go and buy a rental property, you run a cost segregation report, you show a ton of losses right from the get-go in year one, deduct those all against your commissions, boom, we're deferring taxes. And we're going to show you, and we're going to do that breakdown, the visual breakdown for you on an actual deal to show you what this looks like, show you the returns that it looks like. Okay. So that's the gist of it. That's what real estate professional status allows you to do with the IRS code. So this is their rules. This is their laws. Now we're going to get into who qualifies, how you qualify, right? So let's dive into that. Let's go full screen. Matt, you want to take this part?
Absolutely. So there's a couple things that are required to qualify as a real estate professional. You have to have more than half of all the personal services that you provide be working in a real property trade or business. There's a breakdown. There's 11 items, I think, that count as that qualify. We'll read those in just a second. The second thing then is that the number of hours that you work in that business has to be more than 750 hours. So more than 750 hours in a real property trader business, and more than half of all the work that you're doing is in a real property trader business.
Yep.
Also, stipulation, you have to have at least 5% ownership of that business for that to qualify as well.
So for the people we're talking to today, probably mostly real estate agents, we're trying to give that this information is for you, right?
You own 100% of your business. You're a 1099 contract worker.
Yes. And if this is your full-time thing, you're spending more than 750 hours in your business. Yeah. As long as you don't have a side hustle that's using more of your hours throughout the year, right? Then we're fine. We're going to hit both of those qualifications, and then that additional third one of owning 5% of your business. Now, the key here is you need to be doing business, a real property trade, or business in real property. Okay, so this is where everyone kind of loses their shorts over, and where there's actually a lot of gray area written into the IRS code, but we're just going to go through this. So a real property trade or business, I'm reading this directly from publication 925. It's the IRS outlining exactly how this works. Okay, a real property trade or business is a trade or business that does any of the following with real property. Okay, there's 11 different things here. Develops or redevelops it, constructs or reconstructs it, acquires it, converts it, rents or leases it, operates or manages it, or brokers it. Okay, so you as a real estate agent, you are brokering real estate, and there's actually a tax court case that went to court, and they proved that the real estate agent, although they did not have a broker's license, they work on behalf of the broker, and they're doing the services of the broker. Okay, so you as a real estate agent, you've got your license, you're working full time, you're hitting the 750 hours, it's more than anything else. You qualify as a real estate professional. So the strategy that we're about to talk about and outline is your strategy. You qualify for this. There are all sorts of people trying to qualify as a real estate professional. There are doctors, there are lawyers, there are dentists, there are high income earners who are like, how can I get my butt to be a real estate professional?
Yeah.
Right. And so there are all sorts of people who are wanting to do this. And those are the people that get caught, and those are the people that get in trouble, right? Let's use common sense. Let's read the code. Let's make sure that you are following and abiding by all the hoops that you got to jump through. This makes sense, okay? You are a real estate professional. Now, we help clients in a lot of those other areas that we just went through: develops and redevelops real property, constructs, reconstructs real property, acquires it, converts it, rents it, leases it, operates or manages it. Now, we help a ton of clients, and there's some gray area there, and you're going to find a lot of different area. Tried to correct myself there. You're going to find a lot of different responses from CPAs, and they're going to have a lot of different opinions, and this is up to interpretation. Now, the IRS code goes on to outline some of these, but they skip over like one specifically, right, about construction and reconstruction.
That's unhelpful.
Yes, very unhelpful. And so it's up to interpretation, right? Matt and I have talked in depth about this. What qualifies somebody as construction or reconstruction of real property, right? And a lot of what it's come down to is like, our understanding as real estate professionals, we understand what real property is, right? It's really anything that's bolted down and becomes part of that property. Anybody who's a real estate agent who's watching this video understands the old, like, hey, is a TV mount, does that come with the house when you sell it? Yeah, it bolted to the wall. It became part of that real property. Like it's not personal property anymore. You attached it to the property, right? So there's a lot of things. There's a lot of theories and interpretations of people outside of the real estate industry who might not fully understand just like what real property is.
If we were to get super creative with that, we're not going to. We're not going to try and stress the truth here for somebody. But somebody could look at that and say, hey, well, I run a business that bolts TVs to the wall. That is my entire business. And on that line of thinking, somebody could say, well, I mean, that would count then because it's part of the structure. That's really stretching the truth.
Don't recommend
that's
that.
Not a good idea. We're talking about like full construction components systems.
Yeah, things that become real, like actual part of that house, right?
They're not intended to leave.
And it's not somebody working in conjunction with the construction industry where they create the thing, right? Maybe they manufacture the cabinets in a factory and then they just ship it. And the actual person goes and installs it. Right. No, like you got to be in reconstruction or construction. You're installing these. You're making the real property. You're part of that process. Okay, so something that we wanted to touch on. But if you're a real estate agent, you qualify. Boom. We've already covered that. We went over that. Okay. Moving forward, I think we're probably ready. We've kind of made our point into why you qualify, why this is important. Now that we have your ear, now that you're listening, let's go ahead and talk through a strategy and what this would look like in the real world.
So, absolutely. So I got some notes here. We've got a deal that we're looking at. There's a property with 3 doors, 3 units. We're making it a little anonymous here with the address 123 Main Street.
This is a listing that we're going to have coming on the market in like a couple of weeks. So we're using legit real numbers. We're not making this up. This is in Phoenix.
Yeah, we're trying to figure out how to underwrite a property and what the numbers actually look like, and this is a good example of it. So looking at a purchase price for 3 doors, 3 units of $525,000. With that, a standard investment loan is going to end up being 20%, right around. It can be up to 25%. It can get creative with some other lending that gets it out of that, but we're going to use 20% in this example. So $105,000 down payment, and actually that's the number that we're going to use for kind of a breakdown of the return on investment as well as we break that down. Structure value. When we talk about depreciation, the things that can be depreciated are the structure and land improvements. Land improvements gets a little fun with like car washes and gas stations and stuff like that. And the residential side, it's mainly the main structure. And so what doesn't get to be depreciated is the land. With the structure itself, the IRS has 2 different schedules. They say for residential properties that gets depreciated down as a useful life of 27.5 years. For a commercial property, they extend that out a little bit and they say it's going to have a useful life of 39 years. So for this example, the math is all done based on residential property, 27.5 years here. So with this, looking at comps in the area, looking at what the average space rent is in this area, this property rents, you can see rents right around $4,100, I think, for the 3 units combined. This is total income, all of it.
Yeah. And this isn't hypothetical. That is actually what it's renting for right now. There's 3 tenants in the property. They have signed leases. That's what it brings in between all 3 units. Okay. So,
current investment loan, I think we used 8% as like the annual rate on that, just for math's sake. You might get a better rate, but maybe not. A little higher with investment loans than they are a personal residence. Okay. But principal, interest, taxes, and insurance (PITI) come out to right around $3,300. And so we can see already if we're bringing in $4,100 of income and we're paying out on the PITI $3,300 of income, kind of our gross number for how much we're going to cash flow on that is right around $800 a month. Right. There's other things that you need to take into account. You need to take into account your capital expenditures. That's the AC breaks after 10 years of use or 12 years of use, whatever. They seem to break a lot faster in this heat. Vacancies between tenants, you have maintenance costs, you have potentially property management. The strategy we're talking about here, we're really talking about a real estate agent that is going to self-manage that property. That is how you're going to have enough hours to put towards material participation in the property that you can even qualify for this. So you qualify under the 750 hours and more than half of your time spent in a real property trade or business. But beyond that, to be able to take this and move all of these over to the active side, the IRS also wants you to materially participate in that property. And there's a breakdown, I think 7 different rules for what they say. Hey, you can qualify under these 7 little tests.
Yeah.
We're not going to go over that today, but there's some of them that kind of work better for some people and some better for others.
It's dependent upon the person and their situation, depending on the time of year that you buy the property. There might be different ways to qualify that material participation. Again, depending on how many properties you own, right? Because you can actually elect to group the material participation together with several properties. And so a lot of the court cases actually like fail, and the person wasn't qualified. Maybe they qualified as a real estate professional, but they didn't qualify for the material participation in their rentals. A lot of that had to go with like they didn't group their properties together, and they just failed to document and log those hours. So a lot of like hoops that you do need to jump through to make sure that you are doing it correctly and can prove it in the event of an audit. But again, we're just touching kind of on the high level here. We can get into all the nuance. Endlessly. Right.
So with the cash flow being right where it's at, just want to note real quick, our advice to anybody buying a residential rental property is to have cash on hand, have reserves set aside so that you can take care of some of those unexpected things. When the roof finally fails, it's gonna feel unexpected. You should expect it. We should expect it, planning ahead for these items. They're going to happen at the worst time. And so having some money set aside for that so we're not in a panic is super important. But just the gross numbers on cash flow here, we're looking at about $800 a month that can cash flow in this. So pretty good.
Yep. Okay, cool. So we're going to go into the next piece of this where we break down, hey, these are the things that you should be looking or can be looking at, right? And maybe I'm going to move this just so we can see. Perfect. So we're going to be looking at this, and these are the 4 things that you should be looking at. Look, a lot of people purely focus on cash flow. A lot of people focus on appreciation. Depending on what markets you are around the country, right? We're in Phoenix.
Yeah.
We used to be a pretty good cash flow economy, and we've seen property values just skyrocket and affordability go down, right? And so we're actually trending more towards an appreciation market, something similar to California, where it's like, okay, well, you buy something out in California, you're probably not going to cash flow at all. You're probably going to be negative cash flow, but you buy it for the appreciation. So
it's a long play.
Right. Now we like to factor in all of these things: appreciation, mortgage reduction, cash flow, tax benefits when we're underwriting a deal, because they do all come into effect. It isn't just about the cash flow. Am I investing for the long term? Yes, I am, because I'm going to utilize the tax benefits. I'm going to allow the tenants to pay down that mortgage. I'm going to utilize that. I'm going to let the market do its work, right? And so this is where we break down some of the numbers. Let's start with appreciation, right? So we have a value of the property at $525. That's what we bought it at, okay? And we're just going off of a 2% annual appreciation.
This is conservative.
Yeah.
I've heard this broken down recently, and we were talking about a 5% annual return. We're not going to see that all the time. 2% is a conservative number. You could see better. You could see worse. You could be stagnant in growth, but 2% is pretty reasonable to assume.
Nothing guaranteed. No one ever expects appreciation to happen and like banks on it, right? But it's still something that we should look at when we purchase a property. It's still something that we can anticipate over the long-term period of a hold. And whether you're in X zip code or Y zip code here in Phoenix, that appreciation can change a lot, right? There's some zip codes that appreciate way better than some others. And so being mindful of that and just understanding that, in general, Phoenix metro area, we have a ton of big business coming. I mean, we have chip factories going in all around the valley. North and south, right side, east and west side. There's all sorts of tech companies coming here. Lots of jobs, lots of growth. Phoenix as a whole is doing well. And in terms of like annual appreciation, I mean, that's a lot of that's determined off of the old supply and demand. And so when there is more demand than there is supply, we might see that much higher than 2%. Obviously, we saw crazy stuff happen over the last few years, but that number realistically could be closer to, let's just say, 5%. Yeah. But to be completely we just wanted to be what is real, right? We wanted to be on the safe side, 2% annual. What is that?
That's not realized money right away. That you don't see that money until you sell. But that is something that we need to factor in when we're talking about overall return on our investment. That's one of the factors to that. So we need to take that into account.
Yeah, at some point I plan on realizing that, and whether I put some of that right back into property with a 1031 exchange, it's still money that's going to get used for the future purchase. It's still going to get used at some point.
Or a cash out refi. We talk about that as hey, now's not a great time for a cash out refi with the interest rates where they are. If you buy today and interest rates stay where they are today, and you end up with some appreciation, you'll have the ability to do a cash out refi on that property a year or two down the road, 3 years down the road, whatever it is within the rules for the bank, what they want to see for your total value, loan value.
Okay, so let's back up real quick. We bought this property, $525, let's say. We put a 20% down payment, so $105,000. Okay, that's our down payment. Just keeping those numbers real simple there. Let's say the property appreciated 2% in the first year. That's roughly a total value of $10,500. Guess what that is on our money that we put in? That's a 10% return right there. Okay, so keep that in mind. We'll come back to that. Let's move on to mortgage reduction.
Yeah, you look at an amortization table, big word, fun chart. I'm a numbers nerd, so I love looking at these things. But as you start paying down that loan, you see the massive section of that payment is interest at the start, 30-year loan, amortization, long time loan. Big section of that front end, the first bit of good chunk of years that you're paying down that loan is the interest, right? But some of that is principal pay down. So the amount that you actually borrowed. So we took out, $420,000 for this property after the down payment, right? $420,000. With the math on that, as we look at the amortization table a year down the road, that principal has been paid down right around $4,000. So $4,121 is what the chart said, so that's what we put on here.
It's 3.9%, and we rounded up to 4. Right?
So
okay, cool.
4%-ish return on that, and we call this a return. If this was just on your primary residence, it wouldn't work the same way. But we call this a return because your tenants are paying this down for you. They're paying this down plus the cash flow. So it is an actual thing, again, to calculate in the math when we're trying to underwrite whether or not this is a good deal.
Yep. Now, when we're building wealth, now we have two things working for us, right? We've got appreciation of our asset working upwards, and we've got our principal reduction working downwards. And we're getting this bigger gap. This is where wealth sits, right? This is where the bigger this spread happens, the more money and more wealth we get, okay? Moving on, let's go to tax benefits.
Excellent.
So if we were to run a cost segregation report, and there's, if you don't know what that is, it's essentially just taking all the components of the house, itemizing it. You use a CPA to do this. They can go ahead and itemize all the components into different lifespans. And what this does is it front loads your depreciation schedule. So like Matt said earlier, normal straight line depreciation for a residential property is over 27 and a half years. So you take the value of that structure, right? 420, and you divide that over 27 and a half years. That's normal straight line depreciation.
Yep.
That is, if you don't use it, you lose it. So if your CPA is not even taking straight line depreciation, that's an issue. They need to take that at the bare minimum, right? And most of them probably are.
It's required,
But in terms of running a cost segregation study and having a report that itemizes all the components out, right now we have, because of the tax law that's passed back in 2016, in the year 2024, right now, we are experiencing a 60% bonus depreciation. So what this means is essentially the components that have a 5, 7, or 15-year lifespan within that house, you get to take 60% of all that value and depreciate it in year one. Okay, so for rough math, we've seen this on a couple of residential properties here, especially right around the valley that we're just basing this off of. that comes out to be about 18 to 22% roughly of the value of that structure. Okay. So for this purposes, we use 20%. No, we didn't. We used less than that, didn't we? Nope, 20% of 420.
It was 20%.
Structure value, right? We subtract the land value from that. So 20% of $420,000 comes to $84,000. So hey, on your Schedule E, when you own this rental property, now on that depreciation line, you get to say, I'm taking $84,000 of depreciation in year one. Okay. So remember, we're going to come back to what real estate professional status allows you to do and why this is so powerful, because this right here is most of the benefit.
That's the magical part.
Yep. So let's just say that you're in the 24% tax bracket. What sort of actual tax savings, like out of your pocket, is that? Well, saves you right around $20,000, $160. And when I say right around, I mean exactly. So
the math on that.
Yep. So that's a 19.2% return. Okay, just on the tax benefits. This is amazing, insanely powerful. That is where real estate investors, full-time real estate investors, this is why Trump gets up on stage and he's like, I haven't paid personal income tax or very little personal income tax. This is how people who invest in real estate are able to take massive losses and deduct them against that personal income. Okay.
Using that strategically year over year allows you to compound the effects as you invest in real estate. We're gonna expand on that a little bit more later, but taking that and reinvesting it just snowballs your wealth building capabilities if you're able to do that.
Yeah. You compare yourself as a real estate professional doing this strategy versus, let's just say, your neighbor, right, is going off. They don't qualify as a real estate professional. They're going off and buying rental properties in the same way. You will blow their returns out of the water, right? Being able to do this. Okay. So then we're going to go and look at the last quadrant here, cash flow. Again, what we talked about earlier, there are some of the other expenses and some things that you should be setting aside, but we'll just count it here. That's about, we said $800 a month cash flow. So $9,600 annually equals roughly a 9% return on that money that you have invested in the property. Okay. So out of that 105 that you invested, you put as a down payment, boom, we're good to go. Now, one more thing that we didn't want to skip over is you buying a house as a real estate agent. What do you get? What do you get when you do a transaction? When you broker a transaction in real estate?
You get that sweet buyer agent commission, don't you?
Exactly.
You get that for yourself on a self deal.
Exactly. So we're actually going to factor that in too, because this is something when we look at buying properties, that's something we're factoring in. We're not taking that out of the equation, right? That's not just like I'm just treating that as my part of my job. It's like, no, I'm getting a 2.5%, 3%, right? We see a range there, 2 to 3% commission on this. Okay, so like that impacts my cash on cash return. That impacts my rate of return here. So we just took 2.5% on this as an example here. So
on this deal, that's $13,125 commission on that sale.
Yep. Okay. So now let's go back. Let's go ahead and add up all of these percentages to see in year one what our return is. Now, 2 of these, you're not realizing the return.
Right. Appreciation and
mortgage reduction.
Right. We don't see that until we realize those gains when we sell a property or when we pull money out of that property.
Exactly. Yeah. But you will realize the tax benefits. You will realize the cash flow, and you will realize that commission. So even like let's add them all up real quick to show you. So 10% return of appreciation, 4%, that's 14, 19.2%, add that, 9, and then 2.5. No, sorry. What is that? 12.5% return on the commission.
54.7% return on your investment.
54% on the $105,000 that you put into that property.
That's year one. Year 2
gets
a little smaller.
It does, because you're not going to get the massive year 1 deduction in depreciation.
Right.
But even if you ran this strategy every single time you buy a rental property, you get a 54% return on your money invested in year 1. That is insane, people. Let's just minus the 14%, right? Because we're not actually realizing the appreciation. Sure. We're not actually realizing the reduction. You're getting a 40% return. An actual realized, holy cow.
Yeah.
right?
Look, things go wrong. Roofs leak. You run into troubles. You should have cash on hand. Again, it's a risky thing to invest money into a single asset. That is without question. Consult CPA. Take a look at the underwriting for the property yourself. These are the things you have to decide for yourself if the risk on that specific property is something that is for you. But with the extra risk comes this amazing reward potential for returns.
Yep. So I want to just go back to this real quick to show us, because this is, again, if we can understand this, you start to unlock the thing that everyone is trying to do with their taxes. You qualify as a real estate professional. You need to be buying rental real estate. You need to be parking your money. Go take those commissions. Go take that excess income from your spouse's W-2 and park it in real estate, because you are at a tremendous advantage for doing that. And you get to take all those losses that you take against those properties and deduct them right against your active income. So there's all sorts of nuances into how this plays out in the real life, right? We're talking high-level strategy here, but this is exactly what we advise clients on. So we walk them through the tax savviness of real estate. We help set up a real estate strategy around that, and then we go help and buy a rental portfolio for them, right? So we set a lot of our clients up who are regular people. They're not full-time real estate investors. We're helping them set up their retirement using real estate because they get to qualify as a real estate professional, take advantage of the massive benefits that are in the IRS code. Uncle Sam loves two types of people more than anybody else.
He has favorites.
He has favorites. He likes business owners and he likes real estate investors.
Why does he like business owners?
Because if you are successful and you grow a business, what does he get to do? What does he do? What does he get to do in terms of tax?
What does he really want?
Right? He wants more taxes.
Yeah.
So he says, okay, if I can incentivize the business owner to grow bigger and grow a successful business, I'm going to tax all their employees. Right? And it's also good for our economy. He's providing jobs and opportunities and stimulating the economy with moving dollars. Hey, every time a dollar exchanges hands, who gets taxed? The government. Uncle Sam does, right? So he wins, right, by incentivizing you to be a small business owner in general, not necessarily even small. And in the same way, he incentivizes people to invest in the infrastructure in the U.S. of A. Okay, so they don't privately. You don't see the government going and building communities for people to live in, right? Those are all private investors. Those are all people investing for the monetary benefit of that. And so they want to incentivize that because it helps give people a place to live. Like that's a private industry. Okay. So he loves both of those types of people more than he loves other people and gives them all sorts of incentives within the IRS code. Now, he's not going to go out and tell you, this is exactly how you do it. This is how you pay less tax. Because guess what? If you succeed as a business owner or you succeed as a real estate investor and you don't know about this, sweet, he gets his cake and he gets to eat it too.
More money,
right? He just gets your tax dollars and all the other tax dollars that he would be collecting. So there's no one telling you to do this, right? It's your job. It's important for you to take a proactive approach to understanding this breakdown right here. Yeah. Active versus passive. Do I have active income coming in? Do I have passive income coming in? Yeah. Okay, how do I build a tax strategy around those two things? And the more we've learned about that, the more it has opened up a world of opportunity in terms of, okay, how can we actually really maximize? Once you know the rules of the game, once you know the rules, how would you play a sport not knowing the rules? You probably aren't going to be very good at it. Well, if you know the rules and you know what you can do and what you can't do, now you can have a strategy. Now you can have a game plan of what you should be doing moving forward. Okay. So that is our talk today on real estate professional status. We went over a lot. If you have questions, let us know. Hopefully this is extremely helpful to you. Hopefully you go and ask your CPA a bunch of follow-up questions. And if they don't know what you're talking about, might be time for a different CPA.
Come talk to us.
Yeah. We'll set you up in the right direction. We are not CPAs. That's not our business. And I don't envy the job of a CPA. We love CPAs. They're great, but they've got 6,000 pages of IRS code to worry about. And so sometimes they just need a quick little refresher on what this exact thing is. Here's where it is in the code. Here's what it says. Here's what we're doing. Here's the plan, right? Having this conversation and understanding it for yourself is going to help you navigate that conversation with your CPA. But if you're a real estate agent and you're looking at this video, you're watching this video and you're like, this is incredible. I did not know that I qualified as a real estate professional. I did not know that this was the benefit that I'm missing out on. Holy crap, I've been in the industry for 10 years. I should have been doing this long ago. Or maybe you already own rental properties. You can retroactively go back and run a cost segregation study and actually get more benefit. If you bought a property in the last 2-3 years, you're going to get 100% bonus depreciation, which is more than what it is right now at 60%. And so you're at a huge advantage. So if you're interested in how you do this, right, we've put together a couple of resources. This is our specialty. We help clients build wealth with real estate, and we want to bulletproof business owners. That is what this series is about. We are helping business owners bulletproof themselves. We are business owners ourselves. We live the American dream, right? We're after the same thing. We're trying to support our families. We're investing money. We're trying to spur the economy around us, and we're passionate about that. But what comes with that is a lot of sleepless nights, a lot of tough days, a lot of we understand that. And so the more we can bulletproof ourselves and have a personal portfolio of real estate that not only reduces our current taxable income by a lot, but also brings in steady cash flow over time and helps our families build wealth as a retirement play, then we start to sleep a little bit better, right? And we want you to sleep a little bit better too. So if you're like, man, this blew my mind, we are putting together a group of people who qualify as real estate professionals. A lot of them are probably going to be agents like you. And that's going to be an opportunity to join that. Just DM us, don't be weird about it. We're not trying to push you into a weird funnel and all sorts of things. DM us. We're going to start putting that group together. And we're going to be dumping in resources like crazy. How does this work in the real world? How do you actually flush this out? How do you log your time? How do you log your hours? What hours actually count? How do I do this? What cost seg study should I be doing? I bought this property in Q4. Now what? How do I, materially participate for that? There's a lot of things that go into the implementation of a strategy like this. And we're going to be walking through a group of people who are in that private group through those strategies, how to navigate some of those things as they come across them. And if you're even more interested and you're like, holy cow, this seems like something I would love to help clients with. I mean, if you're already working and educating your clients on the powers of investing in real estate and building wealth with real estate, right? It starts as a simple conversation. We talk to first-time home buyers about why they should be thinking long-term with their home purchases, how they could go purchase a home, then turn this one into a rental at the very least in a few years, and then start, snowballing a portfolio of homes behind them. There's all sorts of ways to get started. There's easy ways.
And what does that do for that homeowner? I mean, it brings back repeat business for us, right? It's beneficial to us in that way. We get paid on commissions for helping them through the buy process, but it also snowballs their wealth. It grows what they're capable of. So starting out, educating our clients, the home buyers, on that process, on what it looks like, what it could look like for them to realize just a different potential in a property is really helpful.
Yeah. You shouldn't be on this hamster wheel of finding new clients every year. You I'm speaking right to the real estate agent right now. You need a business model that allows you to advise your clients, build wealth for them, have a very easy way to show your value, right? I want to provide more value than I take and pay. And it allows you then to raise the lifetime value of your clients. They come back to you more often. They're buying investment properties. They're not just living in a primary home and living there for 7 to 10 years before they end up moving, right? Most agents are not even in business that long. So the chances of getting a repeat business from somebody like that in our industry is actually really low.
Yep.
And so we get fired up about this because we need, you as an agent you need a better business model. You need to be educating your clients. You need to be doing this yourself. and you need to be helping people build wealth with real estate. And this is one of the really most powerful ways that you can do that. And so if you are interested in that, we are local. We're a local team here in Arizona. And so if you're like, hey, I'm looking for another opportunity, we'd love to chat with you. We'd love to see if we're a good fit, and we can help you build your business right around the same principles that we're building our business with, and actually helping people rather than just going and collecting a one-time commission and paycheck. So if that's you, reach out. Either way, reach out to us through a DM. That's the format of getting in touch with us. And
yeah, nothing weird. Any questions too? Shoot us a DM. We're more than happy to spend time and answer whatever questions you got.
Yeah, if you weren't live, if you're just watching the replay of this and you've got questions, again, either throw them in the comment section now or just DM us. We're real people. We're literally on LinkedIn every day. Like, this is where we connect with all of our relationships. We're trying to provide a ton of value to you, education. As we learn, you learn. We're doing everything to give it to you every single day that we have. So anyway, awesome. 45 minutes in. Great overview on real estate professional status. Look forward to next week in our series of becoming bulletproof and what we talk about there. We're going to have our session number 3, and we'll be talking about another nuance of what we can be doing to become bulletproof business owners. Have a good week.